You are not buying a stock. That flicker of green or red on your screen, that 3 or 4-letter symbol that you track with a strange mixture of hope and anxiety, is not what you think it is. You believe you are participating in the market, making a play, getting in on the action. But you are mistaken. And this mistake, this fundamental misunderstanding of what is actually happening when you click the buy button, is the single greatest barrier standing between you and the kind of wealth creation that leads to true financial freedom. It is the reason why 90% of traders lose money, why portfolios stagnate for years, and why the immense power of the greatest wealth generation engine in human history, the stock market, remains a frustrating and dangerous casino for the vast majority of people. The truth is, that ticker symbol is a distraction. It is a ghost in the machine. It is a manic-depressive narrator telling you a story that changes every second, a story of fear one moment and euphoria the next, and most people listen to that story. They let it guide their decisions, dictate their emotions, and ultimately destroy their capital. But there is another way. There is a mindset, a deep and profound shift in perspective, that separates the gamblers from the owners. It is the intellectual bedrock upon which the entire fortune of Warren Buffett was built. It is the principle that transforms the chaotic noise of the market into a stream of opportunities. It is the realization that you are not buying a stock, you are buying a piece of a business. You are becoming a silent partner in a real enterprise that sells real products or services, that has real employees, that generates real revenues, and most importantly, real profits. When you make this shift, everything changes. The daily wiggles of the price become irrelevant. The breathless headlines from financial news anchors fade into background noise. Your relationship with your investments changes from one of a nervous speculator to that of a patient, long-term business owner. You stop asking, what is the stock going to do tomorrow? And you start asking, how is the business going to do over the next 10 years? This is the single most important secret in all of investing. And over the course of our journey together today, we are going to deconstruct this owner's mindset, break it down into its core components, and install it as your new default operating system for wealth creation. We will move beyond the superficial and into the foundational. We will examine not just the what, but the why. We will explore the deep psychological traps that keep the 99% in the dark, and the practical, applied mental models that can lead you into the light. This is not another video about stock picking tips. This is a fundamental rewiring of your financial brain. This is the final promise of investing made real. Our exploration begins with the most crucial pillar of this entire philosophy, the very heart of the owner's mindset. It is the idea that you must first and foremost see the business, not the ticker. You must train your mind to look straight through the distracting dance of the stock price and see the living, breathing enterprise humming away beneath it. This means understanding its operations, its customers, its competitive landscape, and its financial health, as if you were about to purchase the entire company outright, not just a few shares. Most people get this backward. They see a stock price moving up, and only then do they try to figure out what the company does. The owner starts with the company, and only after a deep understanding is achieved do they even bother to look at the price. To truly grasp the power of this perspective, we must travel back to 1972, to a moment that would forever change the investment philosophy of Warren Buffett and Charlie Munger. It was the year they encountered a charming, old-fashioned candy company, based in California, See's Candies. At the time, Buffett's investment firm, Berkshire Hathaway, was still primarily rooted in the cigar-butt style of investing taught by his mentor Benjamin Graham. The method was quantitative, focused on buying mediocre businesses at statistically cheap prices, getting one last puff out of them, and then selling. They were buying stocks, often broken ones, at prices far below their liquidation value. They were not necessarily buying great businesses. Then came See's. It was a wonderful business, a beloved brand on the West Coast. People didn't just buy See's chocolates, they had deep emotional connections to them. It was a Christmas tradition, a Valentine's Day ritual, a go-to gift that signaled quality and care. The business had pricing power. It could raise its prices year after year to combat inflation, and customers would happily pay because the brand was so strong in their minds. The economics were simple and beautiful. It required very little new capital to grow. It gushed cash. The problem was the price. The C family wanted $30 million for the company. After negotiations, they came down to $25 million. For Buffett and Munger, this was a hurdle. The tangible assets of C's Candies, the factories, the stores, the inventory, were only worth about $8 million. Under their old Ben Graham framework, paying $25 million for $8 million of book value was heresy. It was 3 times book value. It was, on the surface, a terrible cigar-butt investment. A younger Buffett might have walked away instantly, but a wise friend and partner, Charlie Munger, pushed him to think differently. Munger argued that they weren't just buying the physical assets, they were buying the brand. They were buying that intangible, yet incredibly valuable space that C's Candies occupied in the minds of its customers. They were buying the decades of happy memories, the reputation for quality, the automatic purchasing habit. This was an asset that didn't appear on the balance sheet but was far more valuable than any factory or truck. Buffett, in a pivotal moment of intellectual evolution, agreed. They made the deal. They paid the $25 million. And what happened next became the stuff of legend. C's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the subsequent decades, on an initial investment of just $25 million. It required very little additional capital investment. It was, as Buffett would later call it, the all-American business. The key lesson from C's was profound. It taught Buffett that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It was the ultimate proof of the owner's mindset. He didn't buy a ticker symbol. He and Munger flew out, they met the management, they likely tasted the candy, they understood the customer loyalty. They analyzed the business. They saw the durable competitive advantage that the brand provided. The $25 million price tag was not a valuation on a stock. It was the purchase price for an entire enterprise that they intended to own, conceptually forever. This single transaction rewired Buffett's approach to capital allocation and set the stage for his future massive investments in other wonderful businesses with powerful brands, like Coca-Cola and American Express. It was the moment he graduated from being a brilliant stock picker to becoming a legendary business analyst and owner. The reason this simple shift in perspective, from ticker to business, is so difficult for most people lies deep within the wiring of our brains. The psychological principle at play is a combination of the representativeness heuristic and the concreteness principle. Our minds are cognitive misers. They prefer to deal with simple, concrete information rather than complex abstract systems. A stock ticker is the ultimate in simple, concrete information. It's a number. It goes up, which feels good, or it goes down, which feels bad. It's immediate, constantly updated, and requires zero analytical effort to observe. A business, on the other hand, is an incredibly complex and abstract system. It involves supply chains, research and development pipelines, corporate culture, brand perception, management strategy, and competitive dynamics. To understand a business, you have to read dense annual reports, analyze financial statements, and think critically about the future. It's hard work. So the representativeness heuristic kicks in. Our brain, seeking a shortcut, substitutes the difficult question, is this a good business to own for the long term, with a much easier one, what is the stock price doing right now? We allow the simple, concrete ticker to asterisk represent the complex, abstract business. This is a catastrophic mental error. The stock price is not the business. The daily fluctuation of a stock price is a reflection of the collective emotion, speculation, and short-term news flow of millions of people. The value of the business is a reflection of its ability to generate cash flow over many years. These are two completely different things, and on any given day, they can be wildly disconnected. The concreteness principle reinforces this. The pain of seeing a stock you own down 20% is a sharp, concrete feeling. The abstract knowledge that the underlying business just had a great quarter is a weak, intellectual concept that has little emotional power to counteract the visceral sting of the price decline. This is why people panic and sell good businesses during market downturns. They are reacting to the concrete pain of the ticker, not thinking about the abstract value of the business they supposedly own. Adopting the owner's mindset is an act of deliberate, conscious rebellion against this flawed mental wiring. It is the decision to ignore the easy, concrete, and often misleading signal of the price in favor of the difficult but far more important work of understanding the abstract reality of the enterprise. So how can you, as an individual investor, actually put this into practice? How do you force your brain to make this critical shift? You can use a mental model I call the business owner's briefing. It's a simple but powerful exercise designed to sever your emotional connection to the ticker and forge a new, intellectual connection to the business. Here's the blueprint. First, select a company that you are interested in potentially investing in. It could be a company you've heard about, one whose products you use, or one that just seems promising. The first rule of this exercise is critical. For the next 7 days, you are programmatically forbidden from looking at its stock price. You cannot check it on your phone, you cannot look it up on a financial website, you cannot watch it on television. You must treat the stock price as if it does not exist. Your entire focus must shift elsewhere. Your mission over these 7 days is to create a one-page document, your business owner's briefing. This document is what you would want to read if you were considering buying the entire company, not just a few shares. It must answer 5 fundamental questions in plain English, with no jargon. Question 1. How, specifically, does this company make money? What is it selling, to whom is it selling, and what is the transaction that moves money from their pocket to the company's? Be precise. They sell software is not an answer. They sell a subscription-based customer relationship management software primarily to small and mid-sized businesses for an average of $150 per seat per month, is an answer. Question 2. Who are the company's 3 most important customers? If it's a consumer company, describe the target demographic. If it's a business-to-business company, who are the key clients? Understanding who pays the bills is paramount. Question 3. Who are its 3 most dangerous competitors? What other companies are fighting for the same customer dollars? How are they different? Why would a customer choose them over your company? Question 4. What is the single biggest, most plausible threat to this company's revenue over the next 5 to 10 years? Is it a technological shift, a change in regulations, a new competitor? Every business has a potential Achilles heel. An owner must be aware of it. And finally, question 5. If you had to describe the company's core product or service to a 10-year-old, what would you say? This forces you to distill your understanding down to its simplest essence. If you can't explain it simply, you don't understand it well enough. By the end of 1 week of this focused research, reading the company's annual report, listening to investor calls, reading about its industry, you will have created your briefing. Only then, after you have formed a clear, independent opinion on the quality and prospects of the business itself, are you permitted to look at the stock price. And when you do, its meaning will have changed entirely. It will no longer be a measure of the company's worth. It will simply be the price tag Mr. Market is offering you today for a piece of the business you now understand. You will look at that price not as a verdict, but as an offer. And you can calmly decide if that offer is attractive or not, based on your deep knowledge of the underlying enterprise. This exercise, repeated over time, will permanently install the owner's mindset, elevating your executive decision-making from the realm of speculation to the realm of strategic business acquisition. To truly appreciate the power of this approach, we must examine its opposite. We must walk the path of the 99%, the path of the ticker-tape trance. This is the world inhabited by the majority of retail investors. Their journey begins not with a business but with a stimulus. Perhaps they see a stock mentioned on TV, soaring on record volume. Maybe they read a headline about a revolutionary new technology from a company they've never heard of. Or perhaps a friend at a barbecue brags about a stock that has doubled in the last month. The hook is always the price action, the story, the hype. Their research consists of looking at a stock chart. They see a line that has gone up sharply, and a powerful cognitive bias called recency bias kicks in, convincing them that this trend will continue. They pull up a news feed and see a flurry of positive headlines, reinforcing their initial excitement. They feel a rising sense of urgency, a fear of missing out on easy gains. So they buy. They have no real idea how the business makes money. They couldn't name a single competitor. They have never read a page of the annual report. They have purchased a ticker symbol, a story, a lottery ticket. Now they are emotionally hooked. Their days are defined by the color of that symbol on their screen. Green days bring a rush of dopamine, a feeling of intelligence and validation. They refresh their portfolio app dozens of times, basking in the glow of their paper profits. Red days bring a spike of cortisol, a knot of anxiety in their stomach. They frantically search for news, for any explanation for the drop. They are no longer investors. They are gamblers watching the roulette wheel spin. Then, the inevitable happens. The company reports earnings that are slightly below Wall Street's lofty expectations. Or perhaps the broader market enters a correction. The stock drops 10%, then 15%. Panic sets in. Because their ownership was based on the stock price going up, the moment it goes down, their entire thesis is invalidated. They have no underlying conviction in the business itself to fall back on. All the psychological forces that propelled them to buy in euphoria now compel them to sell in terror. They sell, locking in a loss, telling themselves they will get back in when things calm down. Of course, they never do. They have successfully executed the classic, wealth-destroying maneuver: buy high, sell low. They blame the market, they blame manipulation, they blame bad luck, but the real culprit was their perspective. They were in a trance, mesmerized by the ticker, and never once stopped to think like an owner of the underlying business. The financial connection between the owner's mindset and actual, tangible portfolio growth is direct and profound. It manifests on the balance sheet and in the long-term compounding of your capital. An owner, focused on the business, analyzes metrics that reflect the health and profitability of the enterprise. They look at the return on equity (ROE), which measures how effectively the company is generating profits from its shareholders' money. They scrutinize profit margins to see if the company has pricing power and cost controls. They track revenue and earnings growth over 5- and 10-year periods to ensure the business is expanding its value. They study the balance sheet to check for excessive debt that could endanger the enterprise. These are the vital signs of a healthy business. A portfolio built by selecting companies with consistently high ROE, stable margins, and manageable debt is a portfolio of high-quality assets. Over time, the market price of these stocks will inevitably follow the upward trajectory of their underlying business value. The capital gains you realize are not a product of luck or timing, but a direct result of the profits and growth generated by the businesses you own. The gambler, on the other hand, is focused on an entirely different set of metrics. They look at the 52-week high and low, anchoring their decisions to recent price history. They use technical indicators like the Relative Strength Index (RSI) or moving averages, which are purely reflections of past price and volume data, containing no information about the business itself. Their decisions are driven by momentum and volatility. The financial result of this approach is almost always the same: a portfolio churned by frequent trading, with gains eaten up by transaction costs and taxes, and punctuated by large losses when speculative bubbles pop. The owner's mindset leads to wealth creation because it aligns your capital with value creation in the real economy. The ticker tape trance leads to wealth destruction because it aligns your capital with the fleeting and irrational emotions of the crowd. The choice of which path to follow is the first and most important one any investor will ever make. Once you have mastered this foundational shift, learning to see the business behind the ticker, you are ready for the second pillar of the owner's mindset: confronting and taming the allegorical beast that Warren Buffett famously named Mr. Market. This concept, first introduced by his mentor Benjamin Graham, is perhaps the most powerful psychological tool an investor can possess. It is the key to transforming market volatility from a source of terror into a source of opportunity. The allegory is simple. Imagine you are partners in a private business with a man named Mr. Market. He is a very obliging partner. Every single day, without fail, he comes to you and offers to either buy your share of the business or sell you his, at a specific price. The catch is that Mr. Market is a manic depressive. On some days he is euphoric. He sees nothing but a glorious future for your business and offers you a ridiculously high price for your stake. On other days he is consumed by despair. He sees nothing but trouble ahead and, in a panic, offers to sell you his stake at an absurdly low price. He also has another wonderful trait. He doesn't mind being ignored. If his quote for the day doesn't interest you, he will be back tomorrow with a new one. The critical insight here is that you, the intelligent investor, are free to choose how you interact with him. You can take advantage of his manic episodes by selling him your shares at a high price, or you can exploit his depressive funks by buying his shares at a deep discount. Or you can do nothing at all. You are never forced to trade with him. His daily price quote is not a verdict on the value of your business. It is merely an expression of his current emotional state. The fatal mistake that most people make is to let Mr. Market's mood swings dictate their own. They feel euphoric when he is, and panicked when he is in despair. They allow his quotes to inform their view of the business, rather than using their view of the business to judge his quotes. To see this principle in action, we must look at one of Buffett's masterstrokes, his investment in the Washington Post Company in 1973. The context of the time is crucial. The stock market was in the midst of a brutal bear market, one of the worst in decades. The Nifty 50 bubble, where investors had paid any price for large, stable growth companies, had burst spectacularly. Pessimism was rampant. It felt like the world was ending. The Washington Post Company, which owned the iconic newspaper, Newsweek magazine, and several highly profitable television stations, was caught in the downdraft. The stock, which had traded at over $38 a share, collapsed to around $6. Wall Street was in a state of utter panic. Mr. Market was not just depressed, he was suicidal. He was screaming that these great media assets were on the verge of worthlessness. At this point, the market capitalization of the entire company had shrunk to a mere $80 million. Buffett, however, was not listening to Mr. Market's screams. As a prospective business owner, he did his own analysis. He looked at the assets the company owned. He knew that the television stations alone were probably worth over $100 million. The newspaper, a dominant franchise in a key political city, was immensely valuable. Newsweek was a powerhouse. He conservatively estimated that the intrinsic value of the entire business was at least $400 million, and likely closer to $500 million. And here was Mr. Market, in a fit of depression, offering to sell him pieces of this $400 million business for a total valuation of $80 million. It was like being offered a brand new dollar bill for 20 cents. While the rest of the world was selling in a panic, guided by the terrifying price action, Buffett calmly and methodically began to buy. Over the next several months, he invested $10.6 million, a massive portion of his partnership's capital at the time, to acquire a significant stake in the company. He wasn't timing the bottom. He didn't know or care if the stock would go down further the next day. He knew he was buying a wonderful business at a ludicrously cheap price. That was all that mattered. This investment became one of the cornerstones of Berkshire Hathaway's success. The $10 million he invested would eventually grow to be worth over $1 billion, a hundredfold return. He achieved this not through complex algorithms or insider information, but by applying the simple allegory of Mr. Market. He saw the panic for what it was, an opportunity offered by a deranged business partner, and he acted decisively. The power of the Mr. Market allegory lies in how it directly counters two of the most destructive cognitive biases in behavioral finance: loss aversion and herd behavior. Loss aversion, a concept pioneered by psychologists Daniel Kahneman and Amos Tversky, describes a painful asymmetry in how we process gains and losses. Neurologically, the pain of losing $100 is roughly twice as potent as the pleasure of gaining $100. This makes us incredibly sensitive to downturns. When an investor sees their portfolio down 20%, the emotional response is disproportionately strong, triggering a fight-or-flight response. The instinct is to sell, to make the pain stop, even if it's the worst possible financial decision. Mr. Market's depressive episodes are a direct assault on our loss-averse brains. Herd behavior is our innate tendency to find safety in numbers. From an evolutionary perspective, this makes sense. If you see everyone in your tribe running from a rustling in the bushes, it's safer to run with them than to investigate on your own. In the financial markets, this instinct is catastrophic. When prices are soaring, everyone is buying, and the feeling of missing out becomes unbearable. Herd behavior pushes us to buy at the top. When prices are crashing, everyone is selling, and the fear of being the last one holding the bag is terrifying. Herd behavior pushes us to sell at the bottom. Mr. Market's mood is contagious, and the herd amplifies it, creating feedback loops of euphoria and panic. The mental model of Mr. Market acts as a psychological shield against these biases. It reframes the situation. The falling price is not a loss to be feared. It is a discount to be welcomed. The frantic selling of the herd is not a signal of danger. It is the source of the bargain. By personifying the market as an irrational and emotional entity, you create a crucial psychological distance between his behavior and your own. You are no longer part of the herd. You are an observer of it, waiting to capitalize on its predictable follies. You are treating the stock market not as a source of wisdom to be followed, but as a pool of liquidity to be exploited. To make this concept a practical and repeatable part of your investing process, you can implement what is called the market as a servant protocol. This is a disciplined, step-by-step mental model for interacting with market prices that prevents your emotions from taking over. Step 1 is to define your price. This must be done before you even think about buying a stock, and must be based on your business analysis from the first pillar. You must calculate a conservative estimate of the company's intrinsic value per share. Let's say your analysis leads you to believe a business is worth $100 per share. You then must decide on your required margin of safety, a concept we will explore in a later pillar. For now, let's say you require a 40% discount. This means your buy price, the price at which you are willing to act, is $60 per share. You should also have a general idea of the price at which the business would become significantly overvalued, perhaps $150 per share. You must write these numbers down. They are your anchor to rationality. Step 2 is the daily check-in. Once you have your numbers, you are permitted to interact with Mr. Market. You can look at the stock price, but your interaction is framed by a single, simple question. Mr. Market, what is your price today? That is all the information you are seeking. You are not looking for confirmation, validation, or wisdom. You are simply asking for his offer. Step 3 is the binary response. Your reaction to his offer is strictly binary. If the price he quotes is at or below your predetermined buy price of $60, you are permitted to act and purchase shares. If the price he quotes is anywhere above $60, whether it's 61 or 161, your response is a calm and simple, "No thank you." You then close the screen and get on with your day. You do not get excited if the price is rising, and you do not get anxious if it's falling toward your price. You have outsourced the decision to your prior, rational analysis. You are treating Mr. Market as a servant, whose only job is to present you with offers. He is not your guide. He is not your guru. He works for you, and most of the time his offers are not good enough. This protocol systematically prevents you from getting caught up in the emotional tides of the market. It turns a chaotic, anxiety-inducing process into a calm, rational, and businesslike one. The alternative to this disciplined protocol is the path followed by the vast majority of market participants, the path of being a slave to the screen. This individual has no independent calculation of a business's value. For them, Mr. Market's quote is not an offer. It is the truth. The price is the value. Their entire emotional and financial state is therefore chained to the market's manic depressive whims. Their day begins with checking pre-market futures, their mood for the morning set by a 1/10 of a percentage point move. They have financial news channels on all day, absorbing the constant stream of urgent, breaking news, which is mostly meaningless noise. When a stock they own goes up 5%, they feel like a genius. They think, "I knew it! I should buy more before it runs away from me." They are succumbing to greed and the fear of missing out. When that same stock goes down 5%, their stomach tightens. They think, "What's wrong? What does the market know that I don't? I should sell before it goes down even more." They are succumbing to fear and loss aversion. This person is in a constant state of reaction. They have externalized their conviction to the price action on the screen. Because they have no anchor in the reality of the business's value, they are tossed about on the waves of market sentiment. This inevitably leads to a portfolio strategy that is the exact opposite of what is required for success. They feel most comfortable buying when prices are high and everyone is optimistic, the point of maximum risk, and they feel most compelled to sell when prices are low and everyone is pessimistic, the point of maximum opportunity. The financial and emotional toll of being a slave to the screen is immense. It's a high-stress, low-return endeavor that enriches brokers through commissions and the government through taxes on short-term gains, while slowly and surely eroding the investor's capital and peace of mind. The direct financial connection between treating Mr. Market as a servant and building long-term wealth is the most powerful in all of finance. It is the very essence of buy low, sell high. Volatility for the average investor is a synonym for risk and fear. For the business-minded investor who understands the Mr. Market allegory, volatility is the raw material from which superior returns are forged. Every market panic, every sector-wide sell-off, every overreaction to a disappointing quarterly report is Mr. Market in one of his depressive fits, offering you valuable assets for less than they are worth. By systematically taking advantage of these episodes, you are seeding your portfolio with immense pre-packaged future capital gains. The math is undeniable. Let's say you have analyzed a great business and determined its intrinsic value is $100 per share. During a period of market euphoria, Mr. Market might offer you that stock for $120. The slave to the screen caught up in the excitement buys it here. For them to double their money, the intrinsic value of the business must grow all the way to $240 per share, a monumental task. Now, consider the intelligent owner. You wait patiently. A year later, a market panic ensues, and the emotionally fragile Mr. Market offers you the same exact business for $50 per share. You calmly accept his offer. Now, for you to double your money, the stock doesn't even need to reach its current intrinsic value. It only needs to rise back to $100, a price it will almost certainly achieve as sanity returns to the market. You have a built-in 100% return just from the gap between your purchase price and the current conservative value. Daily timed. Plus, you will benefit from all the future growth of the business itself. Your returns are supercharged, and your risk is dramatically lowered. This is not a trick. This is the logical, mathematical consequence of a superior psychological framework. Your ability to divorce your emotions from the market's emotions is your single greatest financial advantage. Once you have learned to see the business and to treat the market as your servant, you must then answer the question, what kind of business should you seek to own? An owner's mindset demands that you think about the long-term durability of the enterprise. You are not looking for a company that will have a good quarter or a good year. You are looking for a company that can thrive and dominate for decades. This brings us to the third, and perhaps most crucial, pillar of the owner's mindset, the search for the inevitable, which means the search for businesses protected by a deep and wide economic moat. An economic moat, a term popularized by Buffett, is a durable competitive advantage that protects a business from being attacked by competitors, much like a moat filled with water protected a medieval castle. It is this protective barrier that allows a company to earn high returns on its capital for very long periods of time. A business without a moat is at the mercy of competition. If it earns high profits, new competitors will flood the market, slash prices, and erode those profits until they are gone. A business with a moat can fend off these attacks and continue to generate wealth for its owners year after year. Identifying and understanding these moats is the true art of business analysis. The quintessential story of an economic moat is Buffett's legendary investment in the Coca-Cola Company. The opportunity to buy arose from a confluence of events in the late 1980s. The market crash of 1987 had made all stocks cheaper, and Coca-Cola had also recently gone through the infamous New Coke fiasco, a marketing blunder that, ironically, ended up reminding the world just how much they loved the original formula. Buffett, applying his owner's mindset, began to dig deep into the business. He didn't just see a company that sold carbonated sugar water. He saw a commercial fortress, an impregnable castle with the widest moat he had ever seen. What was the source of this moat? It wasn't the secret formula, though that helped. It wasn't the bottling plants or the distribution trucks, though those were important. The true, unbreachable moat of Coca-Cola was the brand. It was the two words, Coca-Cola, lodged in the cerebral cortex of billions of people around the globe. It was the mental association, cultivated over a century of advertising, between Coke and abstract concepts like happiness, refreshment, and good times. If you were in a remote village anywhere on Earth and you felt thirsty, the first thing that popped into your mind was likely to be a Coke. This mental dominance was an intangible asset of almost incalculable value. It gave Coca-Cola immense pricing power. It could raise its prices a little bit each year, and people would barely notice or care. It created an automatic purchasing habit. Buffett famously said that if you gave him $100 billion and tasked him with unseating Coca-Cola, he would give the money back and say it couldn't be done. The brand was that powerful. Recognizing the near invincibility of this business, Buffett acted with conviction. In 1988, he invested over $1 billion to acquire a large stake in the company, making it one of Berkshire Hathaway's largest holdings. He saw it not as a stock trade, but as buying a piece of a global economic inevitability. That investment has since paid billions upon billions in dividends and has appreciated enormously in value, proving the immense financial power of owning a business protected by a wide and sustainable economic moat. The reason most investors fail to prioritize the search for moats is rooted in a pair of powerful psychological biases: the availability cascade and the narrative fallacy. The availability cascade is a process by which a collective belief gains more and more plausibility as it is repeated in public discourse. The media loves stories of disruption, of plucky startups toppling lazy incumbents. We are bombarded with narratives about the next big thing, the technology that will change the world. These stories are exciting, available, and easy to recall. As a result, investors are drawn to companies in these hot sectors, convinced they are on the ground floor of a revolution. The narrative fallacy, a term coined by Nassim Taleb, describes our tendency to create simple, coherent, and often simplistic stories to explain complex realities. We prefer a good story to a messy set of facts. A company with a charismatic CEO and a grand vision to change the world makes for a much better story than a boring company that dominates the market for, say, railroad freight or credit rating services. The businesses with the widest moats are often these boring but dominant companies. Their stories are not exciting. Their competitive advantage is often based on mundane things like scale, regulatory hurdles, or high customer switching costs. Because they lack a compelling, simple narrative of revolutionary change, they are often overlooked by investors chasing the next shiny object. The search for economic moats is a deliberate act of resisting these biases. It is the discipline to ignore the exciting but fragile story in favor of the boring but durable reality. It is choosing the fortress over the shooting star. To move from theory to application, you need a systematic way to identify these competitive advantages. You can use a mental model called the Moat Identification Matrix, which breaks down the major types of economic moats into 4 distinct categories. When you analyze a business, Your goal is to determine if it has a strong sustainable advantage in one or more of these areas. The first category is intangible assets. This includes things like brands, patents, and regulatory licenses. A brand like Apple or Nike allows a company to charge a premium for its products simply because of the name attached to it. A patent gives a pharmaceutical company a legal monopoly on a drug for a number of years, allowing it to reap enormous profits. A regulatory license, like those required to operate a waste disposal landfill or a utility, creates a government-sanctioned barrier to entry that keeps competitors out. The second category is switching costs. This moat exists when it is expensive, time-consuming, or otherwise painful for a customer to switch from your product or service to a competitor's. Think about your bank. Moving all your automatic payments and direct deposits to a new bank is a huge hassle, so you are likely to stick with your current one even if a competitor offers a slightly better deal. Enterprise software, like that sold by Oracle or Microsoft, deeply embeds itself into a company's operations, making it incredibly difficult and risky to switch. The third and perhaps most powerful moat is the network effect. This occurs when a product or service becomes more valuable as more people use it. The classic examples are social networks like Facebook or credit card networks like Visa and MasterCard. The reason it's hard to compete with Facebook is because all your friends are already on it. The reason a new credit card struggles is because merchants won't accept it until many customers have it, and customers won't get it until many merchants accept it. This creates a powerful, self-reinforcing competitive advantage. The final category is cost advantages. This is when a company can produce and deliver its products or services at a consistently lower cost than its rivals. This can come from immense scale, like Walmart's ability to negotiate lower prices from suppliers, or from a unique process or access to a cheap raw material. A company with a durable cost advantage can either undercut its competitors on price or maintain the same price and enjoy much higher profit margins. By systematically running a company through this matrix, you can move beyond a vague sense of "this is a good company" and begin to precisely identify the source and strength of its competitive advantage. The antithesis to this disciplined search is the common path of chasing shooting stars. This is the investor who is perpetually drawn to companies with exciting stories but no discernible economic moat. They invest in hyper-competitive industries where barriers to entry are low and rivalry is fierce. Think of the restaurant industry. A new, trendy restaurant concept can look like a huge success for a while, but it's incredibly easy for competitors to copy the menu and decor, and new restaurants are constantly opening, vying for the same diners. There is no sustainable advantage. Or consider the world of trendy tech gadgets. A company might create a popular new device, but if it's not protected by patents or a powerful brand, a dozen cheaper knockoffs from competitors will soon flood the market, crushing profit margins. The classic historical example of this folly was the dot-com bubble of the late 1990s. Investors, swept up in the narrative of the new economy, poured money into any company with .com in its name. They were buying stories of future domination, but they failed to ask the critical moat-related questions. Most of these companies had no barriers to entry, no pricing power, and no path to sustainable profitability. When the narrative broke and capital dried up, hundreds of these shooting stars burned out, and trillions of dollars of investor wealth vanished. They had mistaken a good story for a good business, a fatal error for any long-term owner. The direct financial connection between owning wide-moat businesses and superior portfolio growth is stark and quantifiable. An economic moat manifests directly on a company's financial statements in the form of consistently high returns on invested capital, ROIC. ROIC is a crucial metric that measures how efficiently a company is using its capital, both debt and equity, to generate profits. A company that can consistently generate an ROIC of, say, 20% is a phenomenal wealth creation machine. It means that for every dollar the company reinvests back into its business, it generates 20 cents of profit each year. This is the engine of compounding. A company without a moat, operating in a highly competitive industry, will struggle to earn a return on its capital that is higher than its cost of capital. Competition will force it to lower prices, increase marketing spend, and constantly invest in new equipment just to stay in the game. Its ROIC might hover around 6 or 7%, barely creating any real value for shareholders. Over a 10 or 20-year period, the difference in shareholder returns between a 20% ROIC business and a 7% ROIC business is not linear, it is exponential. The wide moat business becomes a compounding machine, its intrinsic value growing at a rapid and predictable rate. The no-moat business stagnates, its stock price going nowhere as it endlessly fights off competitors in a brutal war of attrition. Choosing to exclusively own businesses with wide and durable economic moats is choosing to align your portfolio with the most powerful and reliable value-creating forces in the capitalist system. Even if you find a wonderful business with a wide moat, your work as an owner is not yet done. A business, no matter how great, cannot run itself. You are entrusting your capital to a team of managers who will make decisions on your behalf. This brings us to the fourth pillar of the owner's mindset, the CEO mindset, which means recognizing that management matters. An owner doesn't just buy a collection of assets. They enter into a partnership with the people running the company. The quality of that management team, particularly their skill in capital allocation and their alignment with shareholders, is often the deciding factor between a mediocre investment and a spectacular one. Buffett has famously said he prefers to buy a business that any idiot could run because sooner or later one will. But his greatest successes have often come from partnering with brilliant, owner-oriented managers. The ultimate case study in masterful management is the story of Tom Murphy and Capital Cities/ABC. Buffett has frequently stated that Tom Murphy is, in his opinion, the greatest business manager he has ever met. Murphy's story is a masterclass in rational, disciplined, and shareholder-focused leadership. He started in 1954 with a single bankrupt UHF television station in Albany, New York. From this humble beginning, he built a media empire through a relentless focus on two things: operational efficiency and brilliant capital allocation. Murphy's management style was legendary. He ran a highly decentralized organization, giving local managers immense autonomy but holding them strictly accountable for their financial results. He despised corporate bureaucracy, keeping the head office staff so small they could fit in a single room. His focus was always on maximizing the cash flow the business generated. But his true genius lay in what he did with that cash. He was a master capital allocator. In 1985, he orchestrated one of the most audacious deals in corporate history. His much smaller Capital Cities Communications acquired the giant ABC television network, a company 3 times its size. It was a minnow swallowing a whale. Wall Street was skeptical, but Buffett, who had known and admired Murphy for years, was not. Berkshire Hathaway helped finance the deal, becoming a major shareholder. Buffett wasn't just betting on the media assets, he was betting on the jockey, Tom Murphy. He knew Murphy would run ABC with the same fiscal discipline and rational approach that had made Capital Cities so successful. And he was right. Murphy and his team ruthlessly cut costs, sold off non-core assets, and transformed ABC into a highly profitable enterprise. The investment was a home run for Berkshire Hathaway. The story of Tom Murphy underscores a key tenet of the owner's mindset. When you invest, you are hiring a CEO to manage your money. You must therefore evaluate that CEO with the same rigor you would use when hiring a key employee. You are looking for integrity, intelligence, and a deep-seated passion for the business that goes beyond just collecting a paycheck. The reason this evaluation is so critical is because of a fundamental conflict that exists in most public companies, a concept known as the agency problem. This problem describes the inherent divergence of interests between the shareholders, the principals or owners, and the management team, the agents. Shareholders want management to maximize the long-term per-share value of the business. Management, however, might have other goals. They might be motivated by the desire to build a larger empire, even if it means making acquisitions that destroy shareholder value. They might want lavish corporate headquarters, private jets, and other perks that drain cash from the business. They might favor short-term strategies that boost their annual bonus, even if they harm the company's long-term prospects. Compounding this problem is the overconfidence bias, which is particularly prevalent among highly successful and competitive CEOs. Many CEOs, convinced of their own brilliance, embark on risky, value-destructive mergers and acquisitions, overpaying for assets and underestimating the challenges of integration. A study by McKinsey found that the majority of M&A deals fail to create any value for the acquiring company's shareholders. Buffett's framework for evaluating management is specifically designed to identify those rare leaders who have transcended these biases. He looks for managers who think like owners, who treat shareholder capital with the same care and prudence as if it were their own family's money. Finding such a manager is like finding a co-pilot who you can trust implicitly to fly your financial plane. To operationalize this search for great management, you can use a checklist called the Shareholder Partner Test. This mental model provides a framework for assessing whether a company's leadership is truly aligned with your interests as an owner. The first step is to read the letters. Go back and read the CEO's annual letter to shareholders for the past 5 to 10 years. This is one of the most valuable, yet most overlooked, documents in investing. Are the letters candid, clear, and direct? Does the CEO openly discuss both the company's successes and its failures? Or are the letters filled with impenetrable corporate jargon, buzzwords, and self-congratulatory platitudes, blaming any problems on external factors? A great manager, like Buffett himself in his own letters, speaks to you as a partner. A promotional CEO speaks to you as a mark. The second step is to track the capital allocation. This is the most important job of a CEO. Look at what they have done with the company's profits over the past decade. Have they reinvested them in high-return projects within the business? Have they consistently repurchased shares but only when the stock price was below intrinsic value? Have they made smart, bolt-on acquisitions that fit logically with the core business? Or have they hoarded cash on the balance sheet, earning a paltry return? Worse, have they engaged in what Buffett calls diversification, making a large acquisition in a completely unrelated field where they have no expertise? A CEO's capital allocation track record is the clearest window into their business acumen and their commitment to shareholder value. The third step is to check the incentives. Look at the company's proxy statement to see how the executive team is compensated. Is their bonus tied to metrics that genuinely create long-term value, such as growth in per-share intrinsic value or return on invested capital? Or is it tied to superficial metrics like revenue growth or the company's stock price, which can be easily manipulated in the short term? You want a CEO whose personal financial success is directly and inextricably linked to your success as a long-term owner. The final step is to check for skin in the game. Does the CEO and the management team own a significant amount of the company's stock? Crucially, did they purchase most of that stock on the open market with their own money, just like you would have to? Or is their ownership composed almost entirely of stock options granted by the company? A manager who buys shares with their own hard-earned cash is far more likely to think and act like a true owner than one who is simply playing with house money. In stark contrast to this diligent approach is the path of the 99%, falling for the cult of the visionary CEO. This is the investor who becomes mesmerized by a charismatic, storytelling leader. They get swept up in the CEO's grand pronouncements about disrupting industries and changing the world. They watch the CEO's slick presentations at conferences and read fawning media profiles, and they mistake this public relations prowess for business genius. They invest in a personality, not a business or a track record. The corporate landscape is littered with the wreckage left by these charismatic but value-destroying CEOs. They are often masters of narrative, able to convince investors to fund their ambitions for years, even in the absence of profits. They prioritize growth at any cost, focusing on vanity metrics like market share or the number of users, while ignoring the bottom line. They build lavish corporate cultures and chase headline-grabbing but strategically bankrupt acquisitions. The investors who fall for this cult often wake up one day to find that the compelling story has unraveled the cash has run out, and their investment is worth a fraction of what they paid. They learn the hard way that a great storyteller is not necessarily a great capital allocator. A true owner looks past the charisma and focuses on the cold, hard numbers and the long-term track record. The direct financial connection between great management and your portfolio growth is profound. Superior capital allocation is a powerful accelerant of compounding. A management team that can consistently reinvest the company's profits at high rates of return creates a virtuous cycle. The profits from year one are reinvested to generate even larger profits in year two, which are then reinvested to create still larger profits in year three. This is what drives the exponential growth of a business's intrinsic value per share. The CEO is the conductor of this compounding orchestra. Conversely, poor capital allocation is a direct drain on your wealth. A CEO who decides to repurchase a huge amount of company stock when the price is at an all-time high is effectively taking your money, as a shareholder, and lighting it on fire. They are overpaying for an asset you already own, destroying value with every share they buy. A CEO who makes a foolish acquisition for billions of dollars has permanently impaired the company's earning power and saddled it with debt. These decisions have a direct and negative impact on the company's long-term value and consequently on the long-term performance of your investment. By selecting businesses run by honest, rational, and shareholder-aligned managers, you are not just buying a great asset, you are partnering with a team that will act as a faithful steward and multiplier of your capital for years to come. We have now arrived at the final, culminating pillar of the owner's mindset. It is the principle that ties everything else together and translates thought into action. You can identify a wonderful business, protected by a wide moat, run by a brilliant management team, and still end up with a terrible investment if you fail to adhere to this last rule. This is the pillar that enforces discipline and protects you from your own worst enemy: emotional enthusiasm. It is the concept that Ben Graham called the three most important words in investing: margin of safety. The principle is simple. An owner is also a shrewd buyer. You must buy a great business only when it is available at a price that is significantly below your conservative estimate of its intrinsic value. That discount, that gap between the price you pay and the value you get, is your margin of safety. It is your protection against bad luck, errors in judgment, and the unpredictable vicissitudes of the economic world. The perfect illustration of this principle in action is one of Buffett's earliest and most spectacular investments: his purchase of American Express in the midst of the salad oil scandal of 1963. The story is a thriller of finance and fraud. American Express at the time had a small but profitable division that issued warehouse receipts. Companies would store their goods in an Amex warehouse, and Amex would issue a receipt guaranteeing the existence of the collateral, which the company could then use to get loans. One of its biggest clients was the Allied Crude Vegetable Oil Company, run by a man named Tino DeAngelis. Allied had borrowed hundreds of millions of dollars from banks, secured by warehouse receipts for vast tanks of salad oil. The scandal broke when it was discovered that DeAngelis was a fraud. The tanks were mostly filled with seawater, with only a thin layer of oil floating on top. When Allied defaulted, the banks that had lent the money turned to American Express, demanding that they make good on the fraudulent receipts. The market panicked. Wall Street assumed that American Express, a company built on trust, would be bankrupted by the scandal. The stock was annihilated, cut in half in a matter of weeks. Mr. Market was screaming that American Express was doomed. This is where Buffett, the business owner, went to work. He ignored the panic and focused on the facts. He knew that the warehouse division was only a tiny part of Amex's business. The real value, the crown jewels, were the travelers' check and credit card businesses. The key question was whether the scandal would permanently damage the public's trust in these core operations. So Buffett did his own on-the-ground research. He went to restaurants and travel agencies. He talked to clerks and customers. He observed that people were still using their Amex cards and travelers' checks without a second thought. The brand, he concluded, was unaffected. The scandal was a fire contained to one small wing of the castle, but the market was pricing the stock as if the entire kingdom was about to burn down. He calculated that the company's intrinsic value, based on the earning power of its core businesses, was at least $65 per share. And yet, due to the panic, he could buy the stock in the open market for $35. This was a massive margin of safety. He was buying $1 worth of business value for about 50 cents. With immense conviction, Buffett invested 40% of his entire investment partnership, a huge bet, into American Express stock. As the company proved its resilience and the scandal faded, the stock price soared, leading to a massive gain for Buffett's partners and cementing his reputation as a brilliant investor. He didn't predict the future. He simply bought a great business at a price so cheap that it provided a cushion against almost any negative outcome. The psychological biases that the margin of safety principle is designed to combat are anchoring bias and confirmation bias. Anchoring bias is our tendency to rely too heavily on the first piece of information we receive. In investing, we often anchor to a stock's recent high price. The businesses were still great, but the investors who had paid for perfection at the peak saw their capital decimated. It took many of them over a decade just to get back to even. They learned the painful lesson that the price you pay is the single biggest determinant of your future return. Even the best business in the world can be a terrible investment if you overpay for it. The direct financial connection between the margin of safety and your portfolio growth is twofold, providing both defense and offense. The defensive benefit is obvious. It protects your downside. If you buy a business worth $100 for $50, and it turns out your valuation was too optimistic, and it's only worth $80, you still haven't lost money. Your margin of safety absorbed the impact of your error. It is the shock absorber for your portfolio, protecting your capital from permanent loss, which is the cardinal rule of investing. The offensive benefit is equally powerful. Your total return as an investor comes from two sources: the growth in the intrinsic value of the business and the change in the valuation multiple the market assigns to that business. When you buy at a large discount, you get to profit from both. As the business grows, your share of the pie gets bigger. And as the market's pessimism fades and sanity returns, the price will rise to meet the business's intrinsic value, causing the valuation multiple to expand. This closing of the gap between the price you paid and the underlying value can provide a massive one-time boost to your return. The math is simple and compelling. Buying a stock at a 50% discount and having it simply return to its fair value represents a 100% gain on your investment, before you even account for any growth in the business itself. It is the ultimate financial advantage, the reward for combining rigorous business analysis with unwavering emotional discipline. You have just installed a new operating system for your financial mind. You have moved beyond the flickering lights of the casino and into the quiet, solid world of business ownership. You now possess the framework that underpins one of the greatest financial fortunes ever built: the owner's mindset. You've learned to look through the ticker and see the business, to treat the manic Mr. Market as your servant, not your master. You know how to identify the economic moats that protect a business like a fortress, how to judge the character and skill of the management team you're partnering with, and most critically, how to demand a margin of safety that protects your capital and supercharges your returns. This is a complete, powerful mental tool for making intelligent investment decisions. But this mindset, as complete as it is for analyzing a single enterprise, is just one powerful gear in a much larger machine of wealth creation. It is the engine. It provides the horsepower. But an engine, no matter how powerful, is useless without a transmission to connect that power to the road. The next layer of Buffett's system, the next critical piece of the map, is about capital allocation strategy. It's about answering the questions that come after you've found a great opportunity. How do you decide how much of your portfolio to put into a single great idea? What is the mathematical and psychological framework for building a concentrated portfolio of high-conviction bets versus a more diversified approach. How do you think about managing your cash, deciding when to be fully invested, and when to hold back reserves for the next great opportunity Mr. Market might offer? The video that has now appeared on your screen is the next part of that map. It is the bridge from the analysis of a single business to the strategic construction of an entire portfolio. It is the transmission that connects the engine you have just built to the road of financial freedom. Most people will stop here, content with the theory they have learned today. But you have come this far because you are not most people. You are on a journey to build a complete mental arsenal, to master the entire system. The next click is not about watching another video. It is about taking the next deliberate step in your evolution as a serious, intelligent investor. It's about completing the blueprint. Click the video and continue your ascent.